You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Welcome, everybody. This is a special edition of the Peter Schiff Show podcast. The reason it's special is I've got a special guest. You see somebody sitting next to me. This young man's name is James Hickman. Some of you may have known him by his pen name, Simon Black. That's how I originally met James. I was calling him Simon for years, even after I knew that his real name was James. It took me a long time before I could call him James because he was Simon. But he had a newsletter that I used to read, and a lot of, some of my followers used to read. And his company was Sovereign Man. And we got to know each other pretty well over the years. I spoke at several of his conferences. I had some big conferences around the world. And we have a lot in common. I mean, he's kind of, like a younger, better looking, maybe even smarter me. I mean, some of his presentations are really remarkable. He knows so much about so many things, but we have a lot in common. And so he's kind of like the son that I never had when I was in my 20s, because I waited a while to get married and have kids. But yeah, you're young enough. I could be your father, But we have a lot in common.
I'm 46.
All right. Well, I'm 62. Do the math. Could have happened.
Okay. Biologically feasible.
Yes,
okay.
yeah, all right.
Highly unlikely, but all right.
But still, I mean, there's enough
right.
of a gap.
All right.
Right. So anyway, but he could obviously he's young and he could kind of follow in my footsteps because none of my actual kids have any interest right now so far in what I'm doing. But I don't know, like a year ago or a little bit more, we decided to kind of merge the publishing end because I always kind of wanted to do a newsletter and I wasn't doing it. And James had this great letter and a business with Sovereign Man. And of course, he has several other businesses. He's an entrepreneur and he has a lot of different companies. But the one that I, was interested in was Sovereign Man. And so we decided to join forces. And we changed the name to Sovereign Schiff. And yes, and a lot of you have
Schiff Sovereign.
Oh, Schiff Sovereign.
Yeah.
All right. Yeah. I got, it's like I get my mutual funds wrong. Yeah. Schiff Sovereign. Excuse me. It's not Sovereign Schiff. Although I am kind of sovereign, but it's Schiff Sovereign. Schiff Sovereign. There we go. Schiff Sovereign. It's kind of like Schiff Gold. We're keeping the Schiff out there and just follow it up. So
you're doing great.
We formed Schiff Sovereign. And I've been talking about Schiff Sovereign, on the regular podcast. I, encourage people to sign up for the free newsletter. It's worth every penny, but we also have a premium service. So you can pay a little bit more and get a lot more. But I wanted to bring James on to introduce him directly to my audience and have a little conversation. So you get to know a little bit more about him and maybe know more about the newsletter. And also James does his own podcast at least once a week like I do. And it's something I like to watch. And I want to make sure that my audience doesn't miss it because his podcasts are not really on my YouTube channel. They're on the Schiff Sovereign YouTube channel. And so everybody should go and, sign up for that, right? Become a subscriber and look forward to those podcasts every week. But anyway, James, say hello to everybody.
Wow. That was a hell of an introduction. We've known each other. Peter and I have been very close friends for a very long time. Everything you get with us is extremely good-natured ball busting. which is pretty much the only way right now. Is just two dudes sitting way too close to each other on
That's
this.
because we don't have the second.
There's supposed to be, there's supposed to be another desk, but whatever. But here we are, anyways. Look, yeah. So if Peter ever talks about Schiff Sovereign, I'm basically the sovereign and Schiff Sovereign. But Peter and I have known each other for ages, and we did talk like it's been maybe like 2 years ago. And we said, look, we talk about a lot of the same things. Peter and I see eye to eye on a lot of things, except crypto. We do not see eye to eye on crypto.
Yeah. And when I first met James, he tried to get me to buy Bitcoin and I would be a lot richer.
And that was
that
was in like 2012.
That was a long
That was
time
in
ago.
2012. It was like, Peter, you should really get into this. No, it sounds like a scam. Okay, man. Okay. So
Yeah.
yeah, but look, on a lot of things, especially that really matter, Peter and I absolutely see eye to eye, and so yeah, we basically kind of merge this and Schiff Sovereign, and so. But we talked about doing this for a long time, and I've been hearing about this this dual desk thing for like a year.
we have it. You can't see it. We have all these new cameras in the studio and a lot of stuff, but we still haven't been able to get it all set up.
Yeah, just so you know, at home there's a drum set over there. There's a bunch of guitars.
You haven't seen the keyboard. We have a great keyboard.
There's a lot of music stuff in
yeah,
here.
This
I mean,
is
this
my
is
wife.
This is right. I mean, his wife.
laughing
I mean,
cat.
she can sing, and this is legit. But anyways, I got tired of waiting around for it, so I called him and said, "I'm just coming to your house." And
Eventually, though, we're going to get when you have other cameras. We'll have a live audience for the Peter Schiff Show podcast because we got the couch over there and seating, and so if some people end up in Puerto Rico. We start doing the podcast with a live audience. We could have some
live audience at Peter Schiff's house. So,
yes, well,
there you go
at the podcast studio. But anyway,
let's get to it.
Let's talk about what's going on. I mean, one of the most interesting things, and James started talking to me about this, and I said, "Wait a minute."
I was surprised you didn't know about this.
No, I was too busy doing this bank shit all day.
Yeah, that's
true.
Have
like I work nonstop now on stuff that doesn't make me any money, and it's just completely frustrating and aggravating.
Sometimes that's what you have to do. Sometimes I know it sucks, but that's the right thing to do.
And that's actually one of the other things we had in common. He's got a bank too in Puerto Rico that now he's got to get rid of because it's a nightmare.
Don't do it.
But don't set up a bank in Puerto Rico, and do not even have a bank account in Puerto Rico. Right? That I've learned that for sure the hard way. But anyway, I want to talk about what's going on with the Fed and the Trump administration's plan for the Fed. Because this is a very interesting angle that really has some profound implications, not only for the country, but for our portfolios and the returns I think that we're likely to generate as a result of this strategy, which I think is very bad for the country, but of course it's very good for the assets that I own. So why don't you take it from there?
Is that noise supposed to be going off?
No, I don't know what that noise is, but I don't know if they can hear it in the mic.
Okay.
I think it's one of the
turn your phone over in case our man calls.
No, I think it's one of those power backup things.
Yeah,
that
fine.
And it's going off.
Okay. Well, I hope you guys don't hear that at home. But anyhow, look, I've been writing about this for a while. I've been talking about this for a while. The United States just recently hit $37 trillion in debt, and that's just the nominal public debt. That doesn't include the unfunded liabilities and all the other things, the Social Security shortfall, the Medicare shortfall, all the other things. Just the gross nominal public debt, $37 trillion. More importantly, the spending, the gross interest cost this fiscal year alone, which is going to end the end of next month, September 30th, 2025. Is going to come in at about $1.2 trillion. This isn't me saying this or Peter saying this. This is the Treasury Department of the United States that puts these numbers out.
That's the interest on the debt.
The interest on the debt they're spending this year is $1.2 trillion, which is significantly more than what is spent on the military and virtually everything else that we think of as government.
The entire national debt didn't even hit $1 trillion until 1980.
That's right.
And now we're spending more than that just in interest,
yeah,
on the national debt. And interest rates are still low. I mean, despite the fact that everybody is complaining about these sky-high interest rates, we have interest rates with a 4 handle on a 10-year Treasury.
Well, we'll get to that because that's sort of the whole point. Now, don't let people fool you. There's a Jedi mind trick that people play sometimes with the national debt, and they go, "Oh, well, we owe it to ourselves," which is the biggest bullshit line ever that somebody could say about the U.S. national debt. What they mean by that when they say we owe it to ourselves, out of that $37 trillion, there's a lot of that that's owed to foreign investors, the Chinese and Japanese and so forth. There's a lot of that that's owed to U.S. banks, money market funds, some mutual funds, hedge funds, et cetera. And yeah, there is some of that is owed to military retirement, to the Federal Reserve, Social Security. The Social Security trust funds own a lot of U.S. government debt. And so when people say it doesn't matter because we owe it to ourselves, I would say, what are you saying? It's okay to not pay it then because we owe it to ourselves? It's okay to default on Social Security? It's okay to default on military veterans who are expecting their retirement checks every month? I mean, of course it's not okay. The fact that we owe it to ourselves, in my opinion, that's the most important debt that we owe. Is the money that we owe to ourselves. That's not the least important debt. That's the most important debt.
Right. But also there's another factor of owing it to ourselves is that not everybody is on the receiving end of what's owed, because there's a lot of younger people who may not own any entities that own treasuries, but they have to pay the payroll tax or income taxes. And so it is a net transfer. So if I told you, hey, John, Smith, you owe, $250,000, but don't worry, you owe it to your neighbor. It's not going to make
that doesn't make it better. It doesn't soften the blow.
Painful that you're still in debt and you still have to be taxed in order to pay money to some other guy, right? The fact that the other guy is John Smith instead of, some guy in China, doesn't matter to you. It's still money that you are obligated to pay.
Fair point. Fair point. So the bottom line is they're spending $1.2 trillion this fiscal year. That constitutes about 22% of all federal tax revenue. Every dollar they spend, 22 cents of that's going out the door just to pay interest on the national debt. Then they pay Social Security. Then they pay Medicare and the other mandatory entitlement spending. Those things, basically the mandatory entitlements like Social Security, Medicare, and interest on the debt, last year consumed all of tax revenue. So everything else that's known as discretionary spending, which includes the military, Homeland Security, national parks, the light bill at the White House, all those things had to be funded with more debt. So it's an unbelievable trajectory. And this number, 22% of tax revenue just to pay interest, is significantly higher than it was just a couple of years ago. Pre-COVID, they're spending a couple of $100 billion a year, $300-400 billion a year, which is a lot, but it was manageable. $1.2 trillion, 22% of tax revenue is an unbelievably high number. Now, I will say, because we have to be intellectually honest, the U.S. has been in this position before. In fact, the most recent time the U.S. was in this position was in the 1990s. And anybody that's old enough to remember, you remember the 1992 presidential election. And
was that the one with
Ross
Perot? Ross Perot with his blackboard,
and his
but the national debt was tiny back then. But
except that because interest rates in the 1980s were so high. I mean, you remember this. I mean, my parents are telling me this, like when I was a kid, we had like a 16% mortgage on this house we lived in. I mean, it was unbelievable. Interest rates in the U.S. were really, really high in the 80s.
But not 92. They were lower by then.
Well, but they had locked in high interest rates. I mean, in 86, when they were selling 10-year Treasury notes, with 15%. So in the 90s, they were still paying this gigantic interest bill. So in the early 90s, the interest bill on the national debt was pushing, 28, 29% of all federal tax revenue. So today it's 22%. So technically today we're actually a little bit better off than we were in the 90s. But the point is they fixed it in the 90s. They did fix it in the 90s that the interest bill as a percentage of tax revenue did go down because they actually looked at the problem. They took it seriously. It took a guy like Ross Perot, a guy who was really, really rich, and spent his own money to go on TV and educate people and say, hey, this is a huge problem. This is a huge, huge problem. And it actually became a national issue and people took it seriously. Today, it's the opposite. Nobody's taking it seriously. This is the sort of thing that should be on the front page of the Wall Street Journal every single day. And it's not. This should be on the House floor every single day. and it's not. And
the
nobody's
only-
treating
right,
it seriously.
And the only reason that the interest bill is lower now than it was then is because the interest rates are still lower. But a lot of that really, really low debt that we took out during the COVID years and even before has, a really, really low coupon.
Right.
But all that is maturing.
That's right.
And so even though it's 1.2 trillion, my guess is that a
gonna get a
year
lot
from
higher.
now, it'll be 2 trillion.
It won't,
Interest on the
not
debt.
in a year, but probably in 2 to 3 years. Yeah,
I
it'll
think
it'll push 2 trillion.
Could be sooner.
It could be
because
sooner.
It depends on what happens to rates.
Correct.
Because if the Fed isn't able to reduce rates, and if rates actually go up, then it's going to accelerate. And if we go through a bigger recession, which I think we easily could do next year, that increases the deficits. So right now they're in the 2 to 2.5 trillion. But if they jump up to 4 trillion a year, and now we have to pay all the interest on that and borrow that, so it really starts to grow exponentially. So the problem is just going to continue to accelerate, especially when we just had the opportunity to pass a budget, and they ended up with the big ugly bill, which took all of the Biden spending and added to it. Right. Not only did they not get rid of that Biden spending that all the Republicans agreed was the problem and why we had all this inflation, it was all the Biden spending. And then the first chance they had to have a budget, they not only didn't get rid of any of the Biden spending, they said, let's keep it all and add more. And then let's throw a tax cut into the mix. So we take this huge problem that we acknowledged, and let's just make it a whole lot worse.
Yeah.
That's what's happened.
Yeah, and the way you pointed this out, I mean, rates are, we were talking about 16% interest rates in the 1980s. Today, they're paying 4-something%, which is, if you could get in a time machine and bring back people from the Treasury Department in the 1980s, and they would look at this today and go, oh my God, that's so cheap. 4%, that's crazy. That's so cheap. And they're looking at this going like 4%, we can't afford to pay 4%. 4% is historically very, very, very cheap. And this is the point, as you pointed out, that starting in the 90s, we started seeing this significant decline in interest rates that lasted for a really long time. And you got into, by the time you had, the turn of the century, 2000, after 9/11, they cut rates again. Rates were low for a really long time. You got the housing crisis as a result of that. Rates started to come up just a little tiny bit, but for most of this century, interest rates have been very, very low, and they just got accustomed to that. So if you think about 5 years ago, in August of 2020, kind of peak pandemic, everybody was cowered in fear in their basement and all these things. In August of 2020, they were able to sell, let's say, a 5-year Treasury note. And the yield on that 5-year Treasury note would have been a couple of basis points, 10, 15, 20 basis points, 0.2%. Now, all of a sudden, it's 5 years later. Guess what? That 5-year note is maturing. So the Treasury Department has to pay that money back. Well, the Treasury Department doesn't have any money. They can't afford to pay it back. So what are they going to do? They got to go borrow more money from the bond market. They got to issue new debt to pay back the old debt. Unfortunately for them, the new debt comes at a, maybe 4.2% interest rate. So you go from 0.2% to 4.2%. That's a 4% difference on, potentially we're talking trillions of dollars that were borrowed back then. So the increase in the interest bill as a result of that, you can see how quickly the government's annual interest bill can increase. It can increase very, very quickly. I don't think it's going to hit 2 trillion next year, but yeah, probably within 2 years and certainly 3, you're going to see $2 trillion.
3 years, it'll be quite a bit more than that.
And the number that's more important is the percentage of tax revenue, right? It's the percentage of tax revenue, because it's like the same thing. It's like, how much of your monthly household income do you have to spend paying, interest on your credit card bill or your, monthly mortgage payment?
Pretty soon, our interest payment will be so high that if we were applying for a mortgage as a country, we wouldn't even qualify.
Yeah, you'd have a 500 FICO score.
Yeah,
or
we have too much debt, and we couldn't
get
even
laughed out of the bank.
Meanwhile, the government is guaranteeing all the mortgages, and we couldn't even qualify for one on our own. But that is the point that, given the fact that we have so much debt now, we should have higher interest rates than we had in the 1980s. than we do now. I mean, the fact that we have such low interest rates is an artificial construct that is the result of all, the QE programs and all the efforts to suppress interest rates. But the market is going to change this. I mean, when interest rates went up, short-term rates went to 20% in 1980, and, longer-term yields were 16%. That is not something that we wanted. It wasn't like, Volcker was like, hey, what would be a great interest rate? How about 20%? Yeah, let's go for 20%. I mean, we didn't have 20% interest rates because we wanted them. It was because we had to have them.
Right.
We didn't have a choice.
Right.
The market raised them, and we had to do that. And to say that, well, that can't happen again. Well, why can't it happen again? If it happened once, it can happen again. And I would argue that we're in a much worse credit situation now than we were back then.
Significantly worse.
And so, but it doesn't even have to go to 20. Imagine if rates went to 10.
Right.
I mean, the whole economy would completely implode if rates went to 10. If short-term rates went to 7.
Right.
Which used to be considered pretty low. I remember, if you watch the movie Wall Street, when Bud Fox is looking around for apartments and the realtor said, hey, I got a connection. I can get you 10% mortgage. Like, that's a great deal. Wow, 10%,
I bought my first house in 2000, and the rate I paid, I was in the Army. I got a VA loan. So I got, no money down. I paid 7.25%. And at closing, the guy who sold me the house, he pulled me aside. He said, I just want you to know what an unbelievably good rate that is. And he was telling me the story about how they are paying, 14, 15%. And he said, we refinanced to a 15-year mortgage just so we could get like something below 10%. And he was like, you have no idea how lucky you are paying 7.25%. Yeah. And I ended up refinancing it a couple years later at like 5%.
Yeah.
And now today, rates are a little bit higher than that.
Now.
But
They're back up around 7. But
there would have been a time not too long ago that 5 would have been considered crazy high. Oh, how could you pay 5? That's crazy.
I've spoken to people who have 30-year mortgages with a 2 handle.
Right. Yeah.
And, I'd say, never leave that house. Right. I mean, you're
well, and that's it. Like, that's one of the reasons why people are kind of stuck. Like, you're in a house, whatever house you bought, 3 years ago, that's pretty much where you got to live now. Well, there's no mobility.
That's what
anymore.
I was telling my podcast audience. I said, look, if you're going to buy a house, make sure you take the longest, biggest mortgage you can get, because your main asset isn't going to be your house. It's going to be your mortgage. And that asset's going to be the bank's liability, because they're going to be sitting on that paper wishing that it didn't exist, because they're, right now, if the Fed funds rate is 4.25% and they're paying 4.25% to borrow money, but they're only getting 3% from your mortgage.
Yeah, except the banks don't sit on the mortgages anymore. They take everybody's mortgage, they roll them up into a housing bond, and they flip it to the government now.
Well, but somebody owns that bond, right? And they're getting that low coupon. Well, but the point is that the low interest rates that we've enjoyed, and obviously, it's all perspective, because somebody didn't enjoy it because somebody got paid a low interest rate. But borrowers have enjoyed really, really low interest rates for a pretty long period of time now, so that people think that this is the way it is, and this is the way it always is. This is the aberration. This is not a normal period. And I think it's coming to an end with a big decline in the dollar and a loss of appetite among foreigners to buy U.S. treasuries and loan us all this money. They don't want to do it anymore. And so as much as Trump and a lot of people want lower interest rates because we need them, because we have so much debt. And Trump even says that we need to reduce our debt burden. That's why we need lower interest rates, so we can lower the cost of the government of servicing. It's not going to happen. And I think that's one of the reasons the Fed is not cutting, is because they're afraid that when they do, long rates are going to go up. And that is going to be a huge problem, and they'd rather not have to deal with it. But everyone's going to be dealing with much higher interest rates, and it's going to be a shock to the economy, and it's going to exacerbate the next downturn. And I think some people in the Trump administration know that, and that's why they've got this plan that James was telling me about,
the money heist
at the Fed. Yeah. So why don't you,
Well, I was telling Peter about this today. I said, hey, that Netflix show Money Heist? And he said, what are you talking about? I said, how have you not heard of the show? This is like super popular, but it's several years old now. It's a Spanish show. In Spanish, it's Casa de Papel. In English, it's called Money Heist. And it's about, and this is not a spoiler because it's like the first couple minutes of the show, basically, is like people go in and it's like they're going to rob a bank. And it turns out they're not actually robbing anybody's bank accounts or holding anybody up directly. They're going in, basically hijacking the national mint and printing. It takes place in Spain. They're printing euros, using the actual, printing, the government printing presses. And they're saying, we're not stealing from anybody. And which is kind of funny, of course. And like, why are all the police outside then? Because it's illegal. Of course, it's illegal when anybody else does it. When central bankers do it, it's just, it's called quantitative easing and so forth.
It's stimulus.
Yeah, it's stimulus, right? So essentially, what we view is, they've been saying this for a long time. The president of the United States has been very critical of the Federal Reserve. What does he call him? Too late, Powell?
Too late, Powell.
Too late,
Well,
Powell.
he's too late, Powell, but he also calls him a moron, an idiot.
He's an idiot. He's all that. Yeah, all that stuff. And like, I always have to say this because I can't believe these words are coming out of my mouth. I'm not defending the Fed. I'm no way defending the Fed. I'm about as critical of the Federal Reserve as Peter. One of my favorite examples came from, would have been May 2023. Too late, Powell was testifying in front of Congress. And you remember this, and they were asking him, they'd started that rate hike cycle. And they said, is there any concern? Are there any issues in the financial system? And he said something along the lines of, basically, nothing we've seen in the data suggests to me that we've tightened too much or we've raised rates too much. 2 days later, Silicon Valley Bank went bust and Signature Bank went bust. We had this sort of cascading
and their
bank fails
as a
result.
Emergency QE.
Yeah, they had to do emergency QE. And it's like, how did you not see that coming? Because what people don't realize, unless you're in the banking business, is that the Federal Reserve is a bank regulator, technically called a supervisor, banking supervisor. So the Fed already had all the data about Silicon Valley Bank. They had all the data. They had the balance sheets. They had the call reports. They had all the things. They should have known that this bank was teetering on insolvency. Yeah. And yet the guy who's in charge of that whole system said, nope, nothing to see here. So, not to mention they completely missed inflation. They totally misdiagnosed it. They totally failed to understand that there might be consequences to the rate hikes. They screwed up.
Going back, they didn't even know there was a housing bubble. Everyone on the Fed denied there was a housing
bubble.
Example.
There's so many of these. Yeah. So in no way am I possibly defending the Fed. However, I also think that giving control of interest rate policy to anybody seems a little bit silly, but just handing it over to politicians, handing it over to the White House, handing it over to the Treasury Department seems like a bad idea. Yet this is clearly what this administration is trying to do, is essentially hijack control of the Federal Reserve. They keep saying, we want to get interest rates down. They're trying to bully this guy publicly to cut interest rates. And Powell's digging his heels in now saying, no, we're not going to do it. And I think part of the reason why they're not cutting rates is because they're getting so much pressure that they know if they cut rates now, it would look like they caved. And so I feel like they're putting up a fight just to show that I'm not going to cave to this pressure.
But almost you'd think that Trump would have to know that, and you would think that
he'd just back off as a result.
He would do this down on the down low. But it also, to me, and I've been saying that he wants to set Powell up as a scapegoat or a fall guy, because to the extent that we do hit recession, which I think we will. In fact, the labor numbers are very bad. And, we could easily have a negative non-farm payroll report for August, except they're not going to release it.
Yeah,
so we're not going to see it.
They'll downward revise it 4 months later.
Well, no, there'd be nothing to downwardly revise because they're not even releasing it. Yeah. And and I bet that the report that we got for July, which was way below estimates, I think that if we actually got the report in September for August, that one would be revised to a negative number. And so Trump is going to, keep a lid on all that bad economic data so he can keep talking about how we have a booming economy and how it's, it's so hot. And if it is hot, it's, because it's burning down. But I think that when, we are, weak, he wants to say it's the Fed's fault. Like, we had this great economy and too late Powell ruined it by keeping rates too high. And so that's why he wants to be out on record as having called for lower rates so he can blame all the problems on the Fed for not doing it.
Well, I think there's something more deliberate here, and what seems very clear to me, and I've been writing about this for a while. I've been writing this saying I think they're really trying to take control of this. It's a money heist. They're trying to take control of the central bank, just like the TV show, but without the guns and the masks and the jumpsuits. Instead, they're doing it, through mean tweets and these sorts of things. And then something interesting happened. A couple of weeks ago, there was a key Fed official that just inexplicably quit. And when I say inexplicably, I mean it literally. There was no explanation given, and her resignation had immediate effect. That's extremely unusual. That's not supposed to happen.
When was the last time something like that happened?
Right, exactly. You just don't see that. I don't remember that happening unless there was a clear reason where you knew that, there was a you remember the scandal they had during COVID, during the pandemic, where they found a couple of the top Fed officials were actually trading stocks on their, on their own watch. I mean, they were making money off of their own monetary policy decisions. So some of these sorts of things, but it's somebody to just resign for no reason, no explanation given, with immediate effect. Not even like, okay, let's give it 30 days. So there could at least be a debate over who my successor is going to be. Nope, I'm gone tomorrow.
And that is weird because these are pretty good jobs, right? They're hard to get, these jobs at the Fed.
Well,
I don't even know what they do. Probably easy work, right? You just sit around and
especially like the tenure on a lot of these positions lasts in many respects for more than a decade. So it's a long-term payday for sure. It's a long-term payday. So I was doing the podcast. I was doing my podcast, and I was telling the guy I do the podcast with, Joe, and I said, man, this just stinks to me, because of course, almost immediately they came out and said, oh, we got a replacement. We're going to replace her with Stephen Moran. Wow. What a surprise. Right. Stephen Moran, the guy who's the brains, if you could use such a term. Yeah. He's the architect of the entire administration's economic policy. And to be fair, I think there are certain things that they say that are, I would say, I get your point. I think they make some valid points. Blowing up the whole trade system and all these things. I don't know that that's necessarily going to prove to be the right decision, but this is the guy who's clearly, he's going to toe the line. He's going to do whatever, the president tells him to do. And now he's going to go and join the Fed. So he's just somebody who's going to go and become a voting member of the Federal Reserve. And I told Joe, I said, politics is a dirty business. I wouldn't be surprised if we saw more of this. People suddenly resigning, or you're going to find out, you're going to wake up one day, you're going to see something in the newspaper that there's some scandal, there's some ethics violation. I actually kind of half joked. I said they're going to do what they did with Spitzer all those years ago. They're going to set him up in a hooker sting, or they're going to say he's on the Epstein list, or something like that to besmirch somebody's character, or set him up in a scandal so the person has to resign. Sure enough, what did we find out? A key Fed official, we just found out today, a key Fed official, the head of the Fed, the FHFA, came out and said, this person's guilty of mortgage fraud. Look here, she signed 2 mortgage applications like 10 or 15 days apart, and both of them were claimed to be her primary residence, which is mortgage fraud.
This is a voting member of the FOMC.
So now this gives them an excuse to say, and of course, immediately Donald Trump said, you need to resign. And of course, they've got a replacement already. So I started to look at this, and this is what I was talking about on my podcast. I said, watch what happens. This is going to happen. And now I didn't expect it to happen so soon, but now it's happened. And I said, little by little, they're going to either build the Fed with their own guys that are going to click their heels and they're going to salute and they're going to say, sir, yes, sir, we're going to cut rates. Or everybody else on the FOMC is going to be so shit scared that somebody's going to come after me. So I'm like, all right, we're just going to capitulate and we're going to start cutting rates.
Yeah, because obviously if they found that this voting Fed member of the FOMC committed mortgage fraud, it was because they were investigating the people on the FOMC, trying to find dirt on them. Right. Clearly, and I'm sure the ones they didn't investigate were
not the only one.
Yeah, the 2 that voted to cut rates last time are probably fine. They're not looking at those guys.
Right.
So all the Fed officials that didn't vote to cut rates, I bet the IRS
There's
is
a
looking
target
over,
on their back. Yeah, there's something.
The IRS is looking over all their tax returns.
Mm-hmm.
You've got FHA, looking over all their mortgage applications.
Right.
Who knows? and they're looking for.
You said it was a cushy job. That's now, voting to hike interest rates or at least not cut interest rates. That's a dangerous job in America
and
today.
If you're on the Fed and you're just not clean as a whistle, you've got some kind of little skeleton in your closet, you're going to be like, I got to get out of the crosshairs. How do I get off of the naughty list onto the nice list?
Yeah.
I'm voting September for a rate cut. Right. And yeah, I mean, they're trying to do it and get everybody to cut rates, but cutting rates isn't going to do it because they said a 1/4 point rate cut, 50 basis points, even if they did that, I bet that it's going to be the same as last time where the long end is going up. Not
I mean,
down.
that's the thing, what they're going to find. I mean, and the thing is, this isn't some wild conspiracy theory either. Earlier this summer, the Treasury Secretary himself gave a speech and he said, here's what we're going to do. We're going to get in there once this guy's out, talking about we're going to get into the Fed once Jerome Powell is out, and we're going to cut rates. We're going to lower those rates. And he's basically saying, he laid out his whole strategy, said, we're going to bide our time for now while the rates are a little bit higher. We're going to keep basically issuing this ultra short-term debt, 90-day T-bills, 6-month T-bills. We're going to keep issuing this short-term debt until we can get Jerome Powell out, and then we're going to cut rates, and then we're going to refinance all the debt to these longer-term rates. So the idea is that they want to push the 10-year yield down. We were saying earlier that 4% is too expensive for them. They want to get the 10-year down to like 2%,
but it's
and then
not
go and
going to
refinance a bunch of the
But it
U.S.
won't
debt.
go down there. That's
right.
the problem.
That's the point.
It's good. The 10-year. So what they're going to have to do when they cut rates and long-term rates go up, they're going to have to continue to refinance on the short end. And they're going to be shortening the maturity of the debt, creating a potential time bomb, because at some point when inflation really runs out of control in a way that they can't deny it, and the dollar goes into free fall, the way it was in the 1970s, the only way to stop it, to stop a hyperinflation, would be to jack short-term interest rates up to 10% or 15%. But then what do you do if your entire national debt is financed in T-bills, and now you got to roll it over
and pay
at those
10%?
Well, then now you're default time. So what then happens is, and if Trump controls the Fed, we obviously can't defend the currency. We can't do a Paul Volcker because we're broke now, and we weren't back then. And so there's no way to stop runaway inflation. There's no way to stop it collapse. And so, then we go into the situation where we probably have price controls, and the government is, trying to do everything it can, to plug all the holes as the ship is sinking. But we have a real dollar crisis and, a sovereign debt crisis, because I don't think these guys realize what they're dealing with. I think they think, hey, we could just cut rates and it'll be like it was during COVID. Like we could get these super low yields, and the Fed was able to do that because the markets let them do it. The markets aren't going to let them do it anymore, and that was made clear on the last Fed rate cut when the long bond went up by 100 basis points instead of down.
And that's the point. I think they're going to find people have I think a little bit of a misconception about the powers of the Federal Reserve. People think the Fed can just sort of clap its hands and push the entire yield curve down. And that's not necessarily true. It's certainly not always true. And it certainly wasn't true when they started this rate cut cycle in 2024 over a basically 3-month period from September 18th to December 18th, 2024. They cut rates 3 times by a total of 100 basis points. And yet the 10-year went up by about 100 basis points.
The mirror image.
Right. So it was the wrong direction. So if the Fed really wants to they have a lot more control over short-term rates rather than long-term rates. And I got a text earlier from an old friend. I told you he was actually working for the Treasury Secretary right now. And he said, well, don't forget about the Genius Act. And the Genius Act is this stablecoin bill. And I actually wrote about this on our site, Schiff Sovereign, basically saying, I actually think the Genius Act is pretty smart in that it's going to bring a lot of money out of crypto, bizarrely, into treasuries, which is not something that somebody would ordinarily think would happen, but it's going to be very short-term treasuries. And I think you could probably see potentially trillions of dollars coming into very short-term treasuries because of the Genius Act and the stablecoin legislation. The problem is they're trying to get long-term rates down, and that's a different animal.
Right, but because the stablecoins can't buy long-term because that's taking credit risk and price risk.
They're regulated money market.
But I think to the extent that money goes into the stable coins, it's got to come out of someplace else. So it could come out of a money market, and that money market was buying Treasury. So you're just maybe shuffling the deck. But
You'll have some money come out of banks and the banking system and so forth. But I think the hope is that there will be money that comes out of Bitcoin and a lot of other cryptocurrencies that go into stable coins.
Maybe that. But the thing about the stable coins that I don't think most people will find appealing as like a place to park their money is that if you put your money in a money market, you get 4% interest.
Right.
And, you can have a checking account on your money market. You can have a debit card. So, you get interest. But if you own a stable coin, you get nothing. It's the issuer that keeps all the interest, not the stable coin holder. So to me, the main use case for stable coins is to trade crypto. If you want to trade in and out of various cryptos and you want to have a neutral position, then you have to go to cash. And so go into a stable coin before you flip it into some other coin. But I don't see a huge pent up demand building for stable coins. I think that's all part of the hype.
Well, we'll see. We'll see. You may be right. You may be right, but we'll see. I mean, like the jury's still out, but I think we'll see some data on that here before long. But the point is that whether it's $0 goes into stable coins or $5 trillion goes into it, I mean, you see all kinds of estimates. If that goes into the stablecoin market under the current legislation with the Genius Act, that's going to be at the short end of the curve. So they're still going to be stuck with, how do I get the 10-year? Okay, fine. Maybe the 10-year yield falls by 50 basis points. They got to get it to 2%. They want to get it to 1%. We did the math on this. And so the only way that the Fed is actually able to do that is through essentially direct manipulation of the bond market, which they call quantitative easing. So this is where they're actually creating money and then using that new money through a very complicated system, going through primary dealers and so forth. But they're essentially buying bonds directly. And by engineering artificial demand for bonds with new money that they create, that suppresses yields. It pushes yields down.
But people forget too, when a lot of the politicians say, or people, not necessarily politicians, hey, why didn't we take advantage of those really low long-term rates when they were there? Why didn't the government sell a lot of 30-year government bonds when they had a one handle or a two handle? And the reason is because if they tried, they wouldn't have had those low rates. It was only because the government wasn't selling a lot of new long-term treasuries that the rates were down. But if they actually tried to take advantage of those low rates by issuing a lot of long-term debt, the rates wouldn't have stayed low. So in order to keep, the rates lower, maybe for the mortgages, they kept it short. And so even if Trump's goal is, well, let's get the rate down to 2% so we can sell a bunch of, 30-year bonds at 2%, who's going to buy a bunch of 30-year bonds at 2%? There's not that big a supply of idiots out there that are going to do it.
Right. So the only idiot in this case would be the Federal Reserve. And the Federal Reserve would only be that idiot if you control the Federal Reserve. Well, that is if you had your boys on the Federal Reserve and you said, hey, I want you to buy X dollars worth of this of 2% yielding 30-year bonds. Realistically, I could see them issuing 0% yielding 30-year bonds. So we did the math on this with a lot of help from Grok. The answer is $10 trillion. If the Fed basically with the money they already have, which is roughly $4 trillion, the treasuries that they own, if they created an additional $10 trillion and used all that to buy government bonds, treasuries, and of all the treasury the Fed owns yielded 0%, that at that point, the average interest rate that the government would have would be basically right around 2%. So you'd have to print $10 trillion essentially.
Right. And, well, what is that going to do to prices if you just
bear in mind when the Fed printed $5 trillion during the pandemic, you got 9% inflation. So I don't know that it's a one-to-one linear relationship, but I mean, I can't imagine they're going to have.
We got a lot more than 9%. It was 9% one year. We got 5%. It was like 25% over 3 or 4 years. That's right. But it wasn't. It was more like 50. And I mentioned on my podcast, I was in Connecticut part of the summer, and I had to redo my pool. I had to fix a bunch of cracks. And when I'm talking to the pool guy, how expensive it is, it's like costing me more to fix this pool than it cost to install it initially. And he said, well, everything has doubled in the last 5 years. Yeah. So, I mean, what's that inflation rate? And he's just saying, well, it's the materials, the labor, whatever. It's doubled over 5 years.
That's a
So
14% annualized
yeah, so
rate.
there's the actual increase in the cost of living dwarfs the official inflation. So what you're talking about, they would have to do to try to manipulate rates down by printing all that money. But yeah, what you're talking about is basically getting rid of even the appearance of independence of the Fed, so that the Fed is now the Treasury and the president, and you really turn the country into a banana republic, because now it's all right, whatever money we need, we just print it. There's no break, right? There's no counterbalance to whatever they want to spend, because if you have an independent Fed, the counterbalance to aggressive deficit spending is, well, interest rates could go up and undermine what I'm trying to do. But if you know that, no, I don't have to worry about these big deficits pushing up interest rates because we control the central bank and we're just going to print money and buy up all the bonds that we're selling. Now you've basically, turned over the press to the government, and now they're going to, just use it, just like, in Zimbabwe or whatever. That's what you're doing, or Argentina before, they had a Malay. The only reason they got a guy like Malay is because they had, so many guys that were ruining the currency for so many years.
Well, I remember when the central banker didn't do what Christina Kirchner wanted to do, she just put the guy in jail. So, it is. I mean, this is why, the market, every time he talks about, I'm going to fire Powell, the market kind of throws a temper tantrum. They back off of it, but it seems, now again, I was surprised that it happened so quickly, but to see all of a sudden you've got people inside the administration go, aha, there's a dirty Fed official. And then the calls immediately for, get this person out, you need to resign.
Yeah, and they're also doing the
Jerome Powell, you're pro mortgage fraud. I mean,
they're doing the same thing, with the cost of remodeling the Fed building.
right.
But I'm sure, look, every government entity is inefficient, right? I mean, obviously, if the Fed is going to build something, it's going to overpay. What do they give a damn? It's not their money. In fact, whatever they don't spend, they have to turn over to the Treasury. So why the hell not? It's like, even before then, the Fed historically had the most expensive office in Washington, because they have to turn over 100% of their profits above a certain return on their investment.
They have a tiny capital level they're supposed to maintain, and everything above and beyond that gets
they're in the 100%
remitted to the Treasury every year. Thanks, Barack Obama.
Yeah. So they're in the 100% tax bracket. So why not? Why not just spend whatever the hell? Because, they'll spend it. But I'm sure if you go through the Defense Department or any of these departments and look at, hey, what did you just pay to buy that, whatever they bought? Yeah. It's not going to be what a normal human being would pay, who was spending their own hard-earned money, who was actually shopping around and trying to get a good deal. They're trying to act like these are the only politicians that are reckless spenders. And meanwhile, look at Trump, look at the Congress, how reckless they are. I mean, if we overspent by $500 million on this building, I mean, that's a drop in the bucket compared to the overspending of the Trump administration and Congress. So, I mean, talk about the pot calling the kettle black when they're making a big deal about the Fed overspending, right? When look at the mirror.
Is that about it?
I don't know.
We're going to wrap it up.
Well, I don't know if we're going to, how long, I don't remember when we started this podcast. We forgot to put the timer.
That's all right.
The timer up. But no, we are headed for a sovereign debt crisis. I mean, that's, no doubt about it. And a currency crisis, and I think the administration doesn't get this and just thinks that, we cut rates after the 2008 financial crisis and everything was fine. And we cut rates after COVID and we printed all this money and the stock market went up and everything seems well. So let's just do more of it, right? Let's just go back to that and let's create another huge bubble, another artificial boom. Look, they want to bring back Fannie and Freddie, right? They're talking about they want to privatize them, except they want to make it even worse than before. Creating Fannie and Freddie, right? Fannie Mae was created by FDR, right? One of the worst presidents, right? Because he dramatically expanded the role of the federal government and tore up the Constitution with all those New Deal programs. Well, out of the New Deal was born Fannie Mae, right? So if you're like a Republican, a conservative, a free market guy, you never liked the idea that the government got into it. But at least Fannie Mae, when FDR created it, was a complete government department. It was not private, and it could only securitize FHA insured mortgages. So it basically packaged up government guaranteed mortgages. And it did that up until 1968. 1968, another horrible president, Lyndon Baines Johnson, one of the worst presidents we ever had, he came up with the idea of, hey, let's privatize them. Let's make this government-sponsored enterprise, right? Let's make them private. But at least he said the government doesn't guarantee these debts. But they made them private. Then in 1970, but still they could only do FHA mortgages. Right. Then in 1970, Richard Nixon, right, another bad president, took us off the gold standard, did a lot of crappy things, right? He came up with the idea of, hey, let's let Fannie Mae buy non-government guaranteed mortgages. Why restrict them to just FHA loans? Let them just buy conventional mortgages. We'll just put restrictions on them, like, what the loan to value ratio could be, how big the mortgage is. But let's let this private company, right, that we sponsored, buy up, debt that we don't guarantee. But even then, even Richard Nixon, and they all said, but there's no government guarantee here, right? This is not like buying a Treasury or a Ginnie Mae. This is, private company issuing its own debt, caveat emptor. And they created Freddie Mac the same year, 1970, because they said, look, we don't want just one company. We want some competition. So let's have two companies competing, in the market. But of course, they created a very big moral hazard, because there was a perception among investors that even though there was no government guarantee, investors assumed that if they got in trouble and if they failed, given the fact that the government had sponsored them, that they would bail out the creditors. So if you bought mortgages from Fannie and Freddie, and then they went bankrupt because the mortgages, sucked and they were low credit quality, that the government would bail you out, right? But the government never said that. The government always said, no, we don't. If you want a government guarantee, buy a Treasury. You buy Fannie and Freddie, you get more yield because we're not backing it, right? Then 2008, they go bankrupt, as I predicted years in advance that they would. I knew these entities would go bankrupt, and they were at the heart of the housing bubble. They didn't insure the subprime, but they were the biggest buyers of subprime mortgages out there. They were helping to keep the subprime market going by buying up all the securities. So they went bankrupt, and sure enough, the government bailed everybody out. So the implicit guarantee turned out to actually be there, right? Everybody was right? So they get put into conservatorship, and they've been in conservatorship ever since. But now that they're in conservatorship, pretty much everybody knows, yeah, it's government guaranteed. In fact, now it's the government that's operating the whole enterprise. So it's not an implicit guarantee anymore. It's pretty much explicit. We all know the government backs it. But at least there's no private profit. The problem with private profit, but a government guarantee, is it's the worst of both worlds, because now people will take excessive risks because they can have a big payday in the short run. And they're able to sell the bonds because the lenders don't give a shit, because they know that the government has guaranteed it. And so they don't bother to check on the credit quality. Credit quality is irrelevant. And that allows the entities to make excess profits, basically, with the government co-signing all their debt. So now what Trump says he wants to do is he wants to bring them back with the implicit guarantee wrapped around it, courtesy of the U.S. government. Trump wants to say they're going to keep their implicit guarantee. Well, then it's not implicit anymore. He's made it an explicit guarantee, because the government has now said something that Lyndon Johnson never said, or Richard Nixon never said. He's coming out and saying, yes, this private company, they're issuing debt that is U.S. government guaranteed, and they have a monopoly on it or a duopoly. In fact, they're actually talking about maybe combining them into one monopoly on converting mortgages into treasuries. One of the most asinine decisions you can make. Of course, it's going to enrich a lot of his donors and supporters who bought up a lot of Fannie Mae stock and who are going to cash out with billions of dollars in profits. But again, what are the other reasons that Trump wants to do this is to flood the economy with cheap mortgage money, which can only be done if now they lower their lending standards again, which they'll be able to do under Trump's watch, because he could basically say, hey, guys, do whatever the hell you want. And the buyers will buy up the debt because it's just U.S. Treasury. So, they're trying to lay the foundation for cheap mortgage money, a credit boom. If we can't have real economic growth, let's create fake economic growth that Trump can take credit for. Right? Let's let the Fed, let's print all this money and spend it, goose the stock market, goose the real estate market, party like it's, 1999 and in a bubble. And who gives a shit when it pops, because I'll be out of office by then, right? That's probably Trump's, thinking.
I have maybe we'll leave it at this point. I think we've been going a while, but I have a slightly more nuanced view, and we can perhaps discuss this more at another time. But one of the things you said back there was that this is going to end in a currency crisis. This is going to, et cetera. So that's guaranteed. And I have a slightly more nuanced view. I think the current trajectory is really bad. There's just no other way to put it. You can't spend 22% of your tax revenue just to pay interest on your national debt, have your national debt growing so much faster than your economy, and be staring down the barrel of significantly higher interest rates, which is going to exponentially grow your outgoing interest payments, the percentage of tax revenue, the percentage of GDP that you have to pay just to service the debt. You can't be a powerful nation. You're not a country. You're not a government that is in a sound fiscal position. That's just something that just doesn't end well. Historically speaking, every single time this has happened throughout history, virtually every single time, it's just ended very, very poorly. There are very few instances in which it hasn't ended in some kind of major issue, major crisis. There are, however, a few exceptions. And we can talk about some of those exceptions, what they were in the past, maybe another time, but there are exceptions. And I would perhaps leave the audience in saying that it is technically possible. There are ways in which a major crisis is avoided and all these sorts of things. It is technically possible, not on the current trajectory. And there's going to have to be a hard turn.
And that's probably
very quickly,
probably much smaller countries that, may have an easier time building the consensus necessary to do that. But I think one of the things that's interesting, I think you probably have explained this better than anybody, is a lot of these countries, you go back throughout history and you look at dominant economic powers, or even countries that maybe weren't dominant, but they were very prosperous. And then they had a crisis. But on the dawn of that crisis, when they were very close to going over the edge, nobody knew. I mean, it seemed like everything was fine until it wasn't, until there was a collapse. And, nobody knew. I mean, yeah, maybe people like me were warning about things. Oh, yeah, eventually, sure, long run. Yeah. But you get right up to the point where you're going up to the edge and you don't even realize that you're about to fall off and you're so close to it, yet it seems like it's so far away. And everything changes, almost overnight, and you find yourself in this crisis. And I think that could happen very quickly in the United States, where our fortunes turn overnight in the currency markets, in the bond market, the precious metals market, where you go to sleep and in the next morning, you're living in a whole new world.
And, anybody that think that can't happen obviously wasn't awake during the pandemic. I mean, we went to bed one day and woke up the next morning to a different world. And you're absolutely right. Things can happen very, very, very quickly. Either way, I mean, things can get better very quickly. Things can get worse very quickly. And, even though I'll say things can get better. You look at Britain in the 1790s, early 1800s. I mean, these people, they had a major financial crisis. Gold specie had left the island altogether. banking crises. They had basically a recession, massive national debt. And most importantly, their mortal enemy was breathing down their necks, and everybody thought they were going to be speaking French before long, and Napoleon was going to come across the channel and enslave everybody. And yet they got over it. They managed to grow their way out of debt. They managed to fix all of their problems. I mentioned the 1990s earlier. They went into the 90s paying 28% of tax revenue just to cover the interest bill on the national debt. And they managed to resolve it. And there are a lot of reasons for that. They got a lot of help from the Fed. And a number of other things, but it's not a foregone conclusion. But man, at this current trajectory, it's not looking good.
And what is there to change it? There's no political pressure to do anything about it when the people that were supposedly elected to make a difference. I mean, look at all that Doge stuff, right? All that, oh yeah, we're going to slash trillions and trillions of dollars out of the budget. That's what Elon Musk was saying. It's all gone, right? Right? It was all smoke and mirrors. It was just rhetoric to get votes. It was just part of the Trump show.
I think Elon absolutely intended to do everything that he set out to do.
Oh yeah, he was but then he ran into reality.
You and I actually argued about this, and you said no, he's not going to be able to do it. I said, come on, you're crazy. The guy who catches rocket ships with chopsticks isn't going to be able to cut some money from the debt. I was wrong. You were right. And it was he just got chewed up by the system. And that, I mean, that's crazy to think that the richest guy in the world couldn't manage to, on his own dime go in there and actually pass the budget.
Look, it's not going to happen. They're just going to do whatever they can to avert a crisis. And unfortunately, the only way to avert the crisis is to make it worse. Yeah, that's the only way you can postpone it is by exacerbating the size of the problem. So at some point, you get to you can't kick that can down the road, and we're going to get that crisis. So meanwhile, we'll wrap this up. My next podcast is going to be Sunday night. I'm going to do one because I'm going to talk about on Friday, we have Powell's final Jackson Hole speech. And so that could be a market mover. And I will be discussing what he says and doesn't say about interest rates and inflation and the economy and stuff like that. And remember to check out James's podcast on the official Schiff Sovereign, YouTube channel, and follow him. He's also on X. I don't know if he's posting as often as I do, but he puts out posts on X. So follow him on social media and start reading the newsletters. I mean, one of the things that I really look forward to reading is the Schiff Sovereign newsletters, because most of them, he's writing them.
Oh, thanks, man.
I'm reading them, and they're really well written. And a lot of times I learn stuff that I didn't even know, and then I can talk about them on the podcast. But those you should make a habit, and the free ones are pretty good. And then there's a lot of extra stuff that you can learn about. In fact, didn't you recently just open up the window for total access? People can become total access members.
Yeah, we have different products and services inside of Schiff Sovereign.
So you want to learn about total access, because I met a lot of the total access members at some of the events that I went to, and it's really a great group of people.
You went to one we had some time ago. We had the former president of Mexico. We did it in Mexico City. And it's just a great group. We do very exclusive, closed door conferences. We bring a lot of very kind of high level. I don't like to use thought leader because that just sounds so 1984. But I mean, people that are quite advanced in a lot of things they're doing, unique investment ideas, all sorts of things, and really, like, our group is so close. These things are like family gatherings. I mean, people really feel
it's really fun.
They've like found their tribe, and it's just I watch my kids play, and they start hanging out with other little kids just because they're the same size, and as an adult, it gets a lot more difficult to meet people that are very like-minded and you share a lot of values and interests with, and that's really what our group is. It's really great. We only open up enrollment, frankly, very rarely, and we are now, so it's worth checking out.
Yeah, so you go, how do they enroll? They just go to Schiff Sovereign, and
they can see it on the website on Schiff Sovereign. Yeah.
All right. Well, great. And hopefully we'll do some more of these podcasts when James is around. He's hasn't been in Puerto Rico too often recently, so he hasn't been in the studio. But he was living here. He was living here for a few years, and now he's abroad. Maybe he'll come back. But it'll be great to have more podcasts with you. Thanks for coming by. Okay. All right. Take care, everybody.